Listen to me. If you think taxes disappear the day you retire, you are making a massive mistake. People, I want you to wake up right now because the tax monster doesn't retire when you do. In fact, if you are a middle-income retiree or someone sitting on the edge of retirement, taxes can actually hit you harder now than when you are working if you don't stand in your truth and plan right now. Look at me. You spent 30, 40, maybe 50 years saving every single dollar. You stayed disciplined. You put money into your traditional 401k and your traditional IRA because everybody told you, oh, you'll be in a lower tax bracket when you retire. Are you kidding me? Lower tax bracket? When you add up your Social Security, your pension, and the withdrawals you have to take from those tax-deferred accounts just to pay for groceries and electric bills, you aren't in a lower tax bracket at all. You are trapped in what I call the retirement tax torpedo. Here is the fear that keeps so many middle-class retirees awake at night. Am I going to run out of money because the government is taking too big a slice? And the answer is yes, if you ignore how retirement income is actually taxed. Let's talk about Social Security. You paid into Social Security every single paycheck of your working life with after-tax dollars. So you assume that money comes back to you tax-free, right? Wrong. The IRS looks at what is called your provisional income or combined income. That is your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits. If you are single and that combined total is just $25,000, up to 50% of your Social Security becomes taxable. If you are married filing jointly and your combined income is just $32,000, the exact same thing happens. If you go over $34,000 single or $44,000 married, up to 85% of your Social Security benefits are subject to federal income tax. Do you know when those thresholds were set? 1984. They have never been adjusted for inflation. So every single year, as cost of living increases push middle-income retirees up, more and more of your hard-earned Social Security gets taxed. And then comes age 73. You think that traditional IRA or 401k money is all yours? It isn't. The IRS is a silent partner in your account, and at age 73, they force you to start taking required minimum distributions, RMDs. They don't care if you need the money or not. They force that money out of your account, count it as ordinary income, and stack it right on top of your Social Security and pension. That sudden surge in taxable income can instantly push you into a higher tax bracket, tax more of your Social Security, and even trigger higher Medicare premiums through IRMDs surcharges. So what is the question you need to ask yourself today? You need to ask, how do I take control of my tax picture before the IRS takes control of me? I do not want you living in fear, people. Fear is the absence of knowledge. Once you know the rules, you hold the power. Here are the exact actionable steps you need to take right now to protect your retirement nest egg. First, look at the gap years. The gap years are the sweet spot between the day you stop working and the age when required minimum distributions begin at age 73. During those years, your earned income drops. That is your golden window to execute strategic Roth conversions. Move money from your traditional tax-deferred accounts into a Roth IRA bit by bit while you are in lower tax brackets. Yes, you pay the tax today on the amount you convert, but once it is in that Roth IRA, it grows tax-free, comes out tax-free, and has zero required minimum distributions for the rest of your life. Second, if you are 70 and a half or older, use qualified charitable distributions, QCDs. If you give money to charity, do not write a check from your personal checking account. Transfer the money directly from your traditional IRA to a qualified charity. That money counts directly toward your required minimum distribution once you hit RMD age, but it never shows up in your adjusted gross income. It stays off your tax return completely, which protects your Social Security from being taxed. Third, manage your withdrawal sequence. Don't just pull money randomly from whatever account is easiest. Coordinate your withdrawals between taxable brokerage accounts, tax-deferred accounts, and tax-free Roth accounts to keep your taxable income just below the thresholds that trigger extra taxes or higher Medicare costs. Stand up for your money. Stop assuming taxes will fix themselves. You work too hard for every single cent to give it away unnecessarily. Take action today, manage your tax brackets, and protect your financial future.